I'm very happy to welcome you, Ali, to the German Venture Conference. Hi.
Hi, I'm very excited to be here. Thank you, Lucas, for having me.
Can you tell us a bit about yourself? Ali, what do you do and why do you do what you do?
Sure. So currently I'm a partner at DCVC Data Collective. It's a venture capital fund in Silicon Valley. I've been here for about 5 years now. Before that, I was an entrepreneur. I'd started two companies before kind of joining the dark side. And for a while, I was like an academic. I was publishing papers and doing a ton of studies. And, I was doing machine learning research on biomedical signals. But afterwards, I started became an entrepreneur and started companies and, eventually found my way into the dark side of venture capital. And I've been investing. I have about 25 portfolio companies with an overall value of over $10-12 billion, which employ about 4,000 people.
Wow, awesome. And at some point, you then decided to write a book about the success of ventures. How did you come up with that idea, and why did you decide to not keep your insights to yourself? And maybe also tell us briefly what the book is about for the ones who have not read it yet.
For sure. So this is a project that started about 6-7 years ago. And this is, after I've had my startups, saw my own fair share of success and failure. And I basically had this question: what is actually different between these companies that raise some venture capital funding and go on and become these massive billion-dollar startups, Facebooks of the world, Microsofts of the world, versus all the other companies which raise some venture capital funding? They still are able to raise money, but they never get to become that big of an outcome. Many of them fail, many of them remain smaller successes. Is there anything that's different between them? And I looked into the studies that have been done, the academic literature or anything that's out there, and there wasn't much. There's some studies, obviously there's some data sets of it, the names of these companies, the names of the founders, the amounts of fundings, the valuations, but nobody had done like a study on how many competitors they had when they started, where the idea came from, everything about the background of the founders, what type of companies they had, worked in before, what type of projects they had started before, to, how they went after the fundraising. So all these, granular questions about these founders and these companies, this data didn't exist. And for some things that existed, there were very academic studies that kind of didn't define, I would say, startups the same way that people in the industry define startups. They may count like a laundromat as a startup, which is, it's a small business and it's a company, but it's not something that like a venture capitalist would look at. So I set on to record this data, to capture this data, and it's very hard to find. So that's why it took me 4 years just to collect this data. It's over 30,000 data points on a ton of companies, a ton of unicorns, and also it had a control group, it had a sample, it had basically the unicorns, and also it had the control group companies that had raised venture capital funding. And a lot of the results were shocking. It showed that there's a lot of stereotypes, there's a lot of wrong misconceptions in the industry, a lot of things that have been talked about, a lot of books that have been written about things that are purely statistically wrong. And that's kind of what prompted me to turn this into a book. So to make it kind of more colorful and more readable, I went out and I interviewed founders of a ton of companies, from founders of Zoom to PayPal to GitHub to Cloudflare, many of these, very fantastic entrepreneurs. I collected their stories, and the book is, 100 stories, 20 interviews, and 30,000 data points, and, distilled in about 16 chapters. That's how I ended up writing this book, and it came out last May, so about 1 year. It's been, one of the best-selling books of the space.
Great. So sometimes you even use pretty simple demographic variables like the age of the founders, but still it's not trivial to find them. Like they're not on Crunchbase and etc. Can you go a little bit more into detail on what was your journey on getting this really big data of the startups?
Yes. So, a lot of this, you are not able to automate this. This is one of those things that don't scale. And this is why I had to, I spent all my weekends, all my evenings for 4 years, just going one by one. In some of these examples, I had to email these founders to collect the data. I had to go and read interviews. I had to use a bunch of different, from their LinkedIn, Crunchbase, PitchBook, all the way to, talking to these founders to collect this data points kind of one by one. Very small parts of this project was automated, or even today you can automate it. We are not there yet with NLP and AI to be able to distill this information. So this was a very manual project, from the age of the entrepreneurs to things that they had done before. And, a lot of this came to show that there's a lot of stereotypes and misconceptions. For example, this age concept, there's this media bias to show young entrepreneurs that are successful. And, when you go on TechCrunch, there's a ton of articles. Look at this 19-year-old dropout. Look at this 21-year-old college student who started this company or who raised this much capital funding. Nobody would write, look at this 42-year-old, entrepreneur who started this company. They would just talk about the company, not about the age of the founder. And a lot of movies that get, built about successful founders, they focus on the age, they focus on the naivete. And, it creates, interesting stories. And, that's the story of some part of these founders. But when you look at the data, it seems like that's the minority of the cases. Those are the interesting stories. And that's why the media has created a bias in the eyes of the investors, in the eyes of the entrepreneurs themselves. That basically my data showed age on itself is not a contributing factor. So when I can compare the control group and basically the samples, there's no advantage or disadvantage to a low or high age. You could be 17 and you could have done a bunch of interesting stuff and you can still go on and be successful. You could be 65 and, similarly go on and become a successful founder or not be a successful founder.
Mm-hmm. Interesting. What else did you find that is not correlated with success, despite maybe media or even investors thinking that it might be or is?
Yeah. So one other stereotype that people talk about is basically needing to have co-founders. Like every accelerator program, anything that you look at, in the early stages, the advice is, go and find a co-founder. We will fund you after you find this co-founder, or there's co-founder matching programs. There's a lot of things about, matching you with someone. On the other hand, there's also, if you come and say, hey, we are 7 co-founders starting this company, there will be some negative connotation around this, like 7 people, 7 co-founders. I'd never heard of that. And just because these are rare cases doesn't mean they're less likely to happen and less likely to be successful. So when I looked at the data, when I compared the control group and the sample group, it turns out number of co-founders, again, does not contribute to success, does not contribute to failure. You can be a solo founder and you're as likely to succeed as 2 co-founders, as 3 co-founders, or 4 or 5. So number of co-founders did not contribute to success. One other factor was education level. So whether you have a PhD or a postdoc or a master's or a bachelor's, that by itself did not contribute to success. On average, these entrepreneurs were obviously more educated than the general population. But once you're at the point that you're good enough that you're raising venture capital funding and you can build this, there's no advantage or even disadvantage to any of these cases when you compare them. So it all depends on what you have done during that time that you were studying. Even there's a lot of stereotypes about needing to be a technical co-founder, needing to be like coming from that certain industry or just being technical. Even when you look at that data, there's a small advantage to being technical, but it's not huge. There's like half of these unicorns and half of these billion-dollar companies are started by non-technical CEOs, which is goes against what a lot of people would say, that you need to be technical, you need to be able to code to be able to be a successful founder. The other stereotype is about having industry experience, having same industry experience. So on average, these founders did have 11 years of work experience. They had worked for their own companies, in different companies, but not necessarily within the same industry. They could have been successful in building a B2B SaaS company and then go on and start a consumer insurance company, go on from a database company to build an e-commerce company. These changes from one space to another space, it was perfectly normal when you look at the data, and actually a lot of people were successful shifting from one industry to another. And actually turns out being and having worked within the exact same industry, that did not contribute to success or failure.
Mm-hmm. Interesting. So with your firm, you kind of overcame these biases of things you think contribute to success. But do you also look at some firms if they have some criteria? Is something that is correlated with success?
100%. So the data basically showed some stuff that does not matter, some stuff that are not correlated with success. And my aim at the book is to educate the world, the kind of the community, the startup community, the founders who might kind of not feel like they can go and make it happen, to investors who might not fund people, then there's a lot of stereotypes that you should forget. For example, another stereotype that just came to my mind is like having family members be co-founders, like two brothers or a couple. A lot of these things are just a stereotype. Just because you're two brothers starting, it doesn't mean you're more or less likely to succeed. These are things that don't matter. There's a ton of things that the data showed do matter. And the book is, parts of the book talks about that. One specific thing is this concept of a super founder. The way a super founder is defined is when an entrepreneur goes on, raises some venture capital funding, or even non-venture capital funding, raises some money and starts a company and closes that loop once, which is raise that funding, hire some people, create a product, and get that to some sort of an outcome. It doesn't need to be a huge outcome. It doesn't need to be a massive success. It doesn't need to be $100 million exit or $1 billion exit. Anything small, a couple $1 million outcome, a $10 million outcome, a talent acquisition, a product acquisition, something that you've experienced that and you've run through that. The next time around that you start a company, that entrepreneur is about 330% more likely to start a $1 billion company. And this is the reason is you're more ambitious, you've earned some money or you've seen how hard it is. So you pick a problem that's much larger than you and you go after a market that's much larger. You have much bigger ambitions. And this time around, you have more resources. You can more easily recruit people. You can more easily access the network. You can more easily access the kind of advisors that you need to learn. So this is one of the success factors, and it's very, very practical as well. If you're an entrepreneur, if you're a founder, look at that startup that you're doing as a learning experience. Hopefully it would be your $10 billion outcome and you'll build the next Facebook. But if that doesn't happen, don't be dissuaded. Try to get that to a finish line, try to learn some stuff from it, try to get an outcome, try to land those employees at some good company or sell the product or IP. And then use that resources to move on and start that next company. And then from that, the next company. And every time you're just more likely to go and, become this massive, successful founder. And the stories that we often hear about, how Instagram was formed or how Facebook or Microsoft was formed, it seems like, a one shot, one night, somebody thought about a genius idea and they created this massive company. But in reality, all of these founders, when you look at the real stories, that was a background. They started a bunch of ideas, they failed, and eventually, after a lot of time and after a lot of, iterations, they ended up becoming the successful founder. So that's the advice to investors and that's the advice to founders to, keep on doing this and eventually you will get there just like everybody else. Just because you don't hear about the story of how many times they failed before or had smaller outcomes, that doesn't mean that, that those things didn't happen. So that's one of the aspects that I talk about in the book called Super Founders.
Okay. Do you have also a recipe for young people, let's say a 15-year-old with the dream of becoming a highly successful founder? Do you have anything you could tell him what he should do or she should do? Yeah,
100%. I think, it's very important to just start, regardless of your age is not not a positive, not a negative necessarily. Try to pick a good problem and try to create that thing in the world. And try to get it to an outcome, try to close that loop, whatever it is, build something that you can sell. I think for somebody that young, my suggestion would be find something that you can build and sell online or in real world. Just get that experience in. If you can make some money online, that's a great experience. One example of this that I have is founder of this company called Calm. It's a meditation app, it's a unicorn company. And the founder was actually in the UK before when he was younger, when he was a college student. And one thing that he built was this website called the $1 Million Homepage, which was, this is back in 2005 or 6, the advertising space wasn't as mature. And he created this website with 1 million pixels by 1 million pixels or 1,000 pixels by 1,000 pixels. And he would sell each of these, groups of pixels for, $10 or $100 to advertisers. And, it was basically one page like Pinterest full of logos of ads. And people would just come to this website and say, okay, what is this about? A lot of media wrote about it. It was like the Alexa ranking of this website was like 78 or something at one point. So a lot of people were curious and he made, a couple $100,000 or $1 million from this. It wasn't a company. It wasn't an exit. It wasn't any of these things, but he just created something that made him some money and he learned working with advertisers and making some money online and things like that. So whatever it's you're doing, try to build something, a small project that you can make money, you can build something, sell something, and learn from it. And eventually, you'll be on your next and next and next effort that hopefully will be much, much bigger and larger at the end.
Great advice. Thank you. So this is the one side, founding a startup, but you are now on the other side, investing in startups. Different challenges. So what do you think VCs need to do in order to find these people who are successful in the end?
Right. So one thing that you'll definitely observe in the venture capital community is that a lot of groupthink happens. That's why some companies become hot and many companies become cold, or many sectors are cold and some sectors are hot. And these things are very, very cyclical. At any point, there's some industries that are very hot and some industries that kind of like 2 years after. I saw this with the wearable, the smart watches and hearables, everything. In 2012 and 2013, this was a very hot space. Then in 2015, it became like a cold, nobody paid attention to it. And in 2017 and 18, with Apple and the AirPods and everything, now, AirPods are one of the on itself, AirPods is one of the largest companies in the world, just selling AirPods. And that's part of the wearables group. You see this with everything. You see this with crypto, you see this with industrial innovation, you see this with aviation, you see this with synthetic biology, with biotech, with drug discovery. Every sector has this kind of hype cycle that, something is okay, becomes hot, becomes cold. And for founders, this thing is kind of, don't necessarily pay attention to these, like go and start something that's, successful and would eventually get there. And similarly for investors, like, thinking from first principles that what companies can last and become, generate value in the long run, regardless of what is hot today or what's not. And that's kind of thinking from first principle. That's one thing for investors. The other thing is just like having that maniac focus on backing the right founders, backing the right entrepreneurs. I think that's very, very important, rather than thinking a lot about, market dynamics or competitive landscapes or, defensibility or all these other things. There's one thing, which is backing the right founder. And even if they fail that time, back them again next time around. And even if failed that or was a small outcome, back them again, unless they've done something wrong or, you observe something that they've done terribly wrong. Just backing up the same founders again and again, that creates a, good luck for creating a bigger opportunity in the next funds and next companies that these founders do.
Okay. Do you, that's now the second side, the dark side, you called it. I wouldn't call it the dark side, the investors. For us, there's also the third one, and this is the research about it. Do you have an agenda for us? What do you need from research as venture capitalists? What interests you, what we would need to contribute to understanding more about what makes founders successful?
Yes. So I think there's a ton that academics and researchers can do. I think we still need a ton of understanding about the impact of startups, the societal impact of startups, and also the stories of, what type of companies did and built. I mean, I wouldn't have collected the data if this data existed in the body of research before. But I hope people after me would continue building and kind of creating data sets like this. But one thing that's very important is doing these academic studies in a way that it conforms to the realities of the world and what people in the venture community or what people in the startup community actually define as a startups, right? And actually define. So I feel like a lot of these academic studies go so broad that the averages and everything else doesn't necessarily conform with what investors are seeing in the day-to-day, with what venture capitalists are.
Where would you set the boundary there as defining a startup?
Exactly. So better defining what a startup is, and it basically the same way that people in the venture community would define what a startup is, or the same way that startup founders are defining what a startup is, rather than taking into account every company that gets started, right? Then there are a ton of small businesses and there's a ton of businesses that get started, but it's not necessarily the same thing as, startups that go and raise funding and, are venture backable and are in that realm. It's very different from a media company or, other non-venture backable companies that gets created, which could be massive, amazing, companies on their own, but it's not necessarily the same thing that, investors would look at and that it define as a venture backable startup.
Okay, great. Thank you so much. The time is already coming to an end. Do you have anything more you want to tell us, which I didn't ask you?
That's a good question. Well, there's a ton to talk about, but I've talked about them in the book. So, it's called Super Founders, What Data Reveals About Billion-Dollar Startups. It is available in Germany. It is available in German too. So
Oh, really?
yes, it's one of the book has been translated in about 6 languages now. One of them is German. It's available in ebook version in German. And also English, hard book and audiobook and everything else in Germany. So if you're interested, go and read. There's 65 data points about each of these companies, and we've probably covered 5 or 6 of them here today. So you can learn about the rest there. And if you have any questions, Ali Tamaseb on Twitter or LinkedIn, feel free to reach out.
All right, thank you so much. It was really nice talking to you. And now let's see what else we can find as researchers, and maybe feed it back to you in the future.
That'd be great.
All right.
Thank you very much, Lukas.